I'm going to tell you something that will probably make you angry. Something that goes against everything you're hearing from Wall Street, from the financial media, from the momentum traders who think this bull market will last forever. The four largest technology companies in the world, the stocks that have driven the market higher for the past decade, the companies that everyone assumes are bulletproof, are dramatically overvalued. And if you own them, you need to get out now before the inevitable collapse. I know what you're thinking. These companies are different. They're not like the dot-com bubble stocks that had no earnings and no business models. These are real businesses with real profits. They're dominant in their markets. They're innovating constantly. They're the future of the economy. And I've heard all of this before. I heard it in 1999 when people told me that Amazon and Yahoo and Pets.com were going to change everything. I heard it in 2006 and 2007 when people told me that housing prices never go down and that subprime mortgages were safe investments backed by sophisticated financial engineering. I was wrong then, they said. I was too early, they said. I didn't understand the new paradigms, they said. And then the bubbles burst. Amazon fell from $107 to $7, a 93% decline. Yahoo fell from $118 to $4, a 97% decline. The housing market collapsed, the banks failed, and the people who mocked me lost everything while I made billions betting against the madness. Right now, in late 2025, I'm seeing the exact same patterns in big tech. The same euphoria, the same disconnect between price and value, the same belief that this time is different, and it's not different. It never is. Bubbles always end the same way, with massive losses for the people who believed the hype and held on too long. Today, I'm going to tell you about 4 tech giants that you need to get out of immediately. I'm going to explain exactly why they're overvalued, what risks they're facing, and why their stock prices are going to collapse over the next 12 to 24 months. And I'm going to give you the mathematics that prove these companies are priced for absolute perfection in a world where nothing is perfect. The first company you need to get out of is Nvidia. Now, I know Nvidia has been the darling of Wall Street for the past 2 years. The stock has gone from $120 in early 2023 to over $140 by late 2025. That's a gain of over 1,000%. Everyone loves Nvidia. They're the picks and shovels of the AI revolution. They make the graphics processing units, the GPUs, that power all the artificial intelligence applications everyone is so excited about. Their revenue has exploded, their earnings have exploded, and Wall Street analysts keep raising their price targets because the story is so compelling. But let me tell you what Wall Street analysts won't tell you. Nvidia is trading at a valuation that requires everything to go perfectly for the next decade, and everything never goes perfectly. Let me show you the math. Nvidia currently has a market capitalization of about $3.5 trillion. That makes it one of the most valuable companies in human history. Their annual revenue is about $130 billion. Their net income is about $65 billion. So they're trading at a price-to-earnings ratio of about 54. Now, some people will say that's not that expensive for a company growing as fast as Nvidia. And if you believe the growth will continue forever, maybe that's true. But here's the problem. Nvidia's growth is entirely dependent on one thing: the continued massive spending on AI infrastructure by a handful of very large customers. Microsoft, Amazon, Google, Meta. These 4 companies account for about 40% of Nvidia's revenue. They're building out massive data centers filled with Nvidia GPUs to power their AI ambitions. And they're spending tens of billions of dollars per year on this build-out. But this can't continue forever. At some point, these companies will have enough AI infrastructure. At some point, the return on investment for adding more GPUs will decline. At some point, they'll slow down their spending. And when that happens, Nvidia's revenue growth will collapse. Let me give you a historical parallel. In the late 1990s, there was a company called Cisco Systems. They made the routers and switches that powered the internet build-out. Every telecom company, every internet service provider, every business building out their network infrastructure was buying Cisco equipment. Cisco's revenue was growing at 40, 50, 60% per year. The stock went from $5 in 1995 to $80 in March of 2000, a 1,500% gain in 5 years. At its peak, Cisco had a market cap of over $550 billion, making it the most valuable company in the world. It was trading at a price-to-earnings ratio of over 150. Everyone said Cisco was the future. The internet was just getting started. The growth would continue for decades. But then the spending stopped. The telecom companies had built out their networks. The dot-com companies went bankrupt. The demand for routers and switches collapsed. And Cisco's stock went from $80 to $8, and 90% decline. The company didn't go out of business. They're still around today. They're still profitable. But the stock never recovered to its 2000 peak. Even 25 years later, Cisco stock trades around $60, still 25% below its peak. This is exactly what's going to happen to NVIDIA. The current AI infrastructure build-out is creating unsustainable demand for their GPUs. At some point, probably within the next 12 to 24 months, the big tech companies are going to slow down their spending. They're going to realize that they've built enough AI capacity. They're going to focus on actually generating returns from their AI investments rather than just building more infrastructure. And when that spending slowdown happens, NVIDIA is going to miss their revenue targets. Wall Street analysts are going to cut their estimates. The stock is going to crater. And people who bought at these prices are going to lose 60, 70, maybe 80% of their money. But it gets worse. NVIDIA is also facing increasing competition. For years, they had a monopoly on high-performance GPUs. But that's changing. AMD is making competitive GPUs. Google has developed their own custom AI chips called TPUs that they use instead of buying NVIDIA GPUs. Amazon has developed their own AI chips. Microsoft is developing their own chips. Apple has always used their own chips. All of NVIDIA's biggest customers are working to reduce their dependence on NVIDIA. They don't want to be held hostage to one supplier. They don't want to pay NVIDIA's premium prices. They want control over their own technology stack. Over the next few years, more and more AI workloads are going to run on custom chips designed by the big tech companies themselves, and that's going to eat into NVIDIA's market share and pricing power. I've also been looking at NVIDIA's gross margins. They're currently running at about 75%. That's extraordinarily high. It reflects their monopoly position. They can charge whatever they want because customers have no choice. But monopolies don't last forever. As competition increases, as customers develop alternatives, NVIDIA's pricing power will erode. Their gross margins will compress. Maybe they go from 75% to 65% to 55%. And when your gross margins compress while your growth is slowing, your earnings get hit from both sides. Revenues aren't growing as fast, and you're keeping less of each revenue dollar as profit. The combination is deadly for a stock priced for perfection. There's also a cyclical element to NVIDIA's business that people are ignoring. The demand for AI infrastructure is highly cyclical. Right now, we're in the boom phase. Everyone is building. Everyone is spending. But at some point, we'll hit a saturation point. The spending will stop or slow dramatically, and NVIDIA will face a severe downturn. We saw this with PC chips in the 2000s. We saw it with mobile chips in the 2010s. We're going to see it with AI chips in the next few years. And when the cycle turns, NVIDIA's stock is going to collapse. So here's my prediction. Within the next 24 months, NVIDIA's stock is going to fall by at least 60% from current levels, maybe more. The company will still be profitable. They'll still be a leader in their space. But the stock is so overvalued right now that even modest disappointments will trigger massive sell-offs. If you own NVIDIA, get out now. Take your profits. Don't be greedy. Don't think you can time the top perfectly. Just get out before the inevitable happens. The second company you need to get out of is Tesla. And I know Tesla has a cult-like following. The investors in Tesla are more like religious believers than rational market participants. They worship Elon Musk. They believe Tesla is going to change the world. They think anyone who questions the valuation doesn't understand the vision. But let me tell you about Tesla's valuation. It makes absolutely no sense whatsoever. Tesla currently has a market cap of about $1.3 trillion. That makes it worth more than the next 10 largest automakers combined. Toyota, Volkswagen, General Motors, Ford, Honda, BMW, Mercedes, Stellantis, Hyundai, and Nissan. Combined, these companies produce about 40 million vehicles per year. Tesla produces about 2 million vehicles per year. But according to the stock market, Tesla is worth more than all of them put together. How does that make any sense? The Tesla bulls will tell you that Tesla isn't just a car company. They're a technology company. They're going to dominate electric vehicles. They're going to lead in autonomous driving. They're going to revolutionize energy storage. They're going to build robots. And maybe some of that is true. Maybe Tesla will succeed in some of these areas. But the current stock price requires them to succeed at all of them, spectacularly, and to do it while facing no competition and making no mistakes. Let me break down the math. Tesla's annual revenue is about $100 billion. Their net income is about $15 billion. So they're trading at a price-to-earnings ratio of about 87. For an automaker trading at 87 times earnings. Toyota trades at about 9 times earnings. Volkswagen trades at about 5 times earnings. Why should Tesla trade at 10 to 17 times the multiple of other automakers? Because they're growing faster? Okay, let's talk about growth. Tesla's vehicle deliveries grew about 20% in 2024. That's decent growth, but it's slowing. They grew 38% in 2023, 40% in 2022. The growth rate is decelerating. And there's a reason for that. Competition is intensifying. When Tesla started making electric vehicles, they had the market to themselves. Now every automaker in the world is making electric vehicles. And many of them are making better vehicles at lower prices. Chinese companies like BYD are selling electric vehicles for half the price of a Tesla with similar or better features. European companies like Volkswagen and Mercedes are making premium electric vehicles that are outselling Tesla in Europe. American companies like Ford and GM are ramping up their electric vehicle production. Tesla's market share in electric vehicles is declining. They had 70% of the US electric vehicle market a few years ago. Now they have less than 50%. And it's going to keep declining as more competitors enter the market. Tesla's competitive advantage was being first. But being first doesn't last forever. And now that everyone else has caught up, Tesla has to compete on the actual merits of their vehicles. And frankly, their vehicles have a lot of problems. The build quality is poor. Panels don't align properly, paint jobs are subpar, interiors feel cheap, customer service is terrible, and the cars are expensive. A Model 3 starts at about $40,000. You can buy a Honda Accord for $30,000. A Toyota Camry for $28,000. These are proven, reliable vehicles with excellent build quality and great dealer networks for service. Why would most people pay $40,000 for a Tesla with questionable quality and poor service? The only reason Tesla has been able to sell vehicles at premium prices is because of the EV tax credits and because early adopters were willing to pay a premium to be first. But the early adopter market is saturated. The people who wanted a Tesla already have one. Now, Tesla needs to sell to mainstream consumers. And mainstream consumers are much more price sensitive and much less forgiving of quality issues. I think Tesla's vehicle sales are going to plateau or even decline over the next few years. The growth story is over. They're going to become a mature automaker with low single-digit growth like everyone else. And when that happens, the stock should trade at a mature automaker valuation. 8 to 10 times earnings, not 87 times earnings. Let's talk about autonomous driving, because that's the other big part of the Tesla bull case. Tesla is supposedly years ahead of everyone else in self-driving technology. They're going to launch robo-taxis. It's going to be a $1 trillion business. Except none of that is true. Tesla's full self-driving system doesn't actually drive itself. It requires constant supervision. It makes mistakes. It's not nearly as good as Elon Musk claims. And they're not ahead of the competition. Waymo, owned by Google, has actual robo-taxis operating in several cities right now. Real self-driving cars with no human driver. They work. They're safe. They're already generating revenue. Tesla doesn't have anything close to that. Tesla's approach to autonomous driving is fundamentally flawed. They're trying to do it with cameras only. No LiDAR, no high-definition maps. Just cameras and neural networks. And while that might work eventually, it's much harder than using LiDAR and maps like Waymo does. Tesla has been promising full self-driving for years. Elon Musk said in 2015 that Tesla would have full autonomy by 2017. It's now 2025 and they still don't have it. How many more years should we wait? And even if they do achieve full autonomy, they're going to face massive competition from Waymo, from Cruise, from Chinese companies, from every other automaker working on the technology. The idea that Tesla is going to have a monopoly on autonomous driving is fantasy. Then there's the energy storage business. Tesla makes batteries for homes and utilities. It's a nice business. They did about $10 billion in revenue from energy in 2024, but it's a low-margin business. They're selling commodity batteries in a highly competitive market. This is not going to be the growth driver that justifies a $1.3 trillion valuation. And the robot idea? Elon Musk showed some prototype robots that can barely walk. They're years away from being useful products. And even if Tesla eventually makes useful robots, so will every other robotics company in the world. This is not going to be a Tesla monopoly. Here's the bottom line on Tesla. It's a car company. A car company that makes about $15 billion in annual profit. Car companies trade at 8 to 10 times earnings. So Tesla should be worth about 120 to 150 billion. It's currently worth 1.3 trillion. That's almost 10 times what it should be worth. The stock needs to fall by 90% to get to a reasonable valuation, and I think it will. Maybe not all at once. Maybe it takes a few years, but it's going to happen. The laws of financial gravity always win eventually. The third company you need to get out of is Microsoft. Now, Microsoft is a better company than Nvidia or Tesla. They have a real, durable business. They're genuinely profitable. They're not a car company masquerading as a tech company, but they're still dramatically overvalued. Microsoft currently has a market cap of about $3.2 trillion. That makes them one of the most valuable companies in the world. And their valuation is based almost entirely on the belief that they're going to dominate artificial intelligence through their partnership with OpenAI. Let me explain what's happening. Microsoft invested about $13 billion in OpenAI. In return, they got access to OpenAI's technology, including ChatGPT and GPT-4. They've integrated this AI technology into all of their products: Bing Search, Office 365, Azure Cloud Services, GitHub. They're charging customers extra for AI features. And Wall Street loves the story. They think Microsoft is going to generate hundreds of billions in additional revenue from AI. But here's what Wall Street is missing. The AI features that Microsoft is selling are not that valuable to most customers. And the costs of providing those features are enormous. Let me give you an example. Microsoft Office 365 Copilot is their AI assistant for Word, Excel, PowerPoint, and Outlook. They charge an extra $30 per user per month for this feature. That's $360 per year on top of the existing Office subscription. Some early adopters signed up for it, but most customers aren't willing to pay $360 per year for an AI assistant that occasionally helps them write emails or summarize documents. The value proposition isn't strong enough. And here's the problem with the economics. Every time someone uses Copilot, it costs Microsoft money. They have to run the query through GPT-4 on NVIDIA GPUs in their data centers. The compute costs are significant. I've seen estimates that each Copilot query costs Microsoft 10 to 30 cents in compute costs. If a user makes 50 AI queries per day, that's $5 to $15 per day, $150 to $450 per month in costs. They're charging $30 per month. The math doesn't work. Now, Microsoft will say that the costs will come down over time as the technology improves and as they build more efficient infrastructure. And that's probably true. But it's going to take years. And in the meantime, they're spending tens of billions of dollars building out AI infrastructure and subsidizing AI features that most customers don't value enough to pay for. Microsoft is also facing the problem that AI is commoditizing. When ChatGPT first came out, it seemed magical. It was way better than anything else available. But now, Google has Gemini, which is just as good. Anthropic has Claude, which many people prefer. Meta has Llama, which is open source and free. Amazon has their own AI models. There are dozens of other AI companies building competitive products. Within a few years, AI capabilities are going to be a commodity. Every software company will have AI features. Customers won't pay a premium for them because they'll be everywhere. This is exactly what happened with cloud computing. 20 years ago, Amazon Web Services was revolutionary. They had a huge head start in cloud infrastructure. Everyone thought they would dominate forever. But then Microsoft built Azure. Google built Google Cloud. Every major tech company built their own cloud. And cloud computing became a commodity business with low margins and intense competition. The same thing is going to happen with AI. Microsoft's early partnership with OpenAI gave them a head start. But that advantage is temporary. Everyone else is catching up. And when AI becomes commoditized, Microsoft won't be able to charge premium prices for it. Let's also talk about Microsoft's core businesses, because those are facing challenges too. Windows is a mature business. PC sales have been flat to declining for years. The PC market is saturated. Everyone who needs a computer already has one. And the refresh cycles are getting longer because computers last longer now. Windows revenue growth is low single digits at best. Office 365 has been a great business for Microsoft. They successfully transitioned from selling software licenses to selling cloud subscriptions. But that transition is mostly complete. The growth rate is slowing. They're running into saturation. Most businesses that are going to subscribe to Office 365 already have. Azure, their cloud business, is still growing, but it's growing slower than it used to. They grew about 30% in 2024 compared to 40 to 50% in previous years. The growth is decelerating because the cloud market is maturing and because they're facing intense competition from Amazon Web Services and Google Cloud. So here's what we have. A company with mature, slow-growing core businesses, betting heavily on an AI strategy that requires massive capital investment, that's generating minimal returns so far, and that's going to face commoditization within a few years. And this company is trading at over 35 times earnings with a $3.2 trillion valuation. That makes no sense. Microsoft should be worth maybe 1.5 to 2 trillion based on their actual earnings and realistic growth prospects. The stock needs to fall 40 to 50% to get to a reasonable valuation. The fourth and final company you need to get out of is Apple. And I know this will make a lot of people angry because Apple is the most widely held stock in the world. It's in every index fund. It's in every portfolio. Everyone owns Apple. But Apple has a serious problem. They've run out of growth. Let me show you what's happening with their revenue. In fiscal 2024, Apple's total revenue was about $385 billion. In fiscal 2023, it was $383 billion. In fiscal 2022, it was $394 billion. Their revenue has been essentially flat for 3 years. Zero growth. Now, Apple bulls will say, look at the profit margins, look at the services revenue, look at the ecosystem, look at the buybacks. And yes, Apple is still very profitable. Their net income is about $100 billion per year. They have incredible margins. They return massive amounts of cash to shareholders through dividends and buybacks. But here's the problem. When a company stops growing, it should trade at a mature company valuation. Apple is trading at about 33 times earnings. That's a growth stock valuation. But they're not growing. Mature companies with no growth should trade at 12 to 15 times earnings. So Apple should be worth about 1.2 to 1.5 trillion. They're currently worth 3.5 trillion. The stock needs to fall by 60% to get to a fair valuation. Let me explain why Apple's growth has stalled. Their main product, the iPhone, is a mature market. Everyone who wants a smartphone already has one. The upgrade cycles are getting longer. People used to upgrade their iPhones every 2 years. Now they upgrade every 4 or 5 years because the phones last longer and because the new features aren't compelling enough to justify the expense. iPhone sales have been flat to declining for several years. In some quarters they're up slightly. In other quarters they're down. But the trend is clear. The iPhone is a mature product in a saturated market. The growth is over. Apple's other hardware products aren't making up the difference. Mac sales are flat. iPad sales are declining. The Apple Watch is a nice product, but it's a small business. AirPods are popular, but also a small business. Vision Pro, their new virtual reality headset, is a complete flop. It's too expensive. It's too heavy. The use cases aren't compelling. They're selling maybe a few 100,000 units per year. That's not going to move the needle for a company with $385 billion in annual revenue. Apple's big hope is their services business. Things like the App Store, Apple Music, iCloud, Apple Pay. Services revenue has been growing at about 10% per year, and services have higher margins than hardware. So Apple is trying to become more of a services company and less of a hardware company. But here's the problem with that strategy. The services revenue is largely dependent on the hardware installed base. People pay for iCloud because they have iPhones. They pay for the App Store because they have iPhones. They pay for Apple Music because they have iPhones. If the iPhone installed base stops growing, the services revenue stops growing too. And that's what's happening. The iPhone installed base is around 1.4 billion devices. It's been at roughly that level for several years. It's not growing meaningfully anymore. So, services revenue growth is slowing. It was growing 15 to 20% a few years ago. Now it's growing 10%. Soon it'll be growing 5%, and then it'll plateau. Apple is also facing regulatory challenges. The European Union is forcing them to open up the App Store to competition. They have to allow third-party app stores on iPhones. They have to allow developers to bypass Apple's payment system and avoid the 30% commission. This is going to hurt App Store revenue, which is one of their most profitable businesses. The U.S. Department of Justice is also suing Apple for antitrust violations related to the App Store and their ecosystem lock-in tactics. If Apple loses these cases, they're going to have to make significant changes to their business model, changes that will reduce their revenue and profit margins. Then there's the China problem. China is Apple's third largest market. About 18% of their revenue comes from China, but sales in China have been declining. Chinese consumers are increasingly buying Chinese brands like Huawei and Xiaomi instead of iPhones. The Chinese government is also restricting the use of iPhones by government employees. And there's always the risk that if U.S.-China relations deteriorate further, the Chinese government could ban or restrict Apple products entirely. Apple's entire supply chain is in China. If there's a serious geopolitical conflict, Apple's business could be severely disrupted. They're trying to diversify their manufacturing to India and other countries. But that's going to take many years and billions of dollars in additional costs. Let's also talk about Apple's dependence on continued innovation. For the past 20 years, Apple has succeeded by introducing revolutionary products. The iPod, the iPhone, the iPad, the Apple Watch. These products created new categories and drove enormous revenue growth. But it's been 10 years since Apple introduced a truly revolutionary new product. The Apple Watch came out in 2015. Since then, what? AirPods are nice, but not revolutionary. The Vision Pro is a flop. They haven't shown any ability to create the next big thing. There are rumors about an Apple car. They've been working on it for over 10 years and spent billions of dollars. But there's still no product. And even if they do eventually release a car, they're going to be entering a brutally competitive market going up against Tesla, legacy automakers, and Chinese companies. It's not going to be the easy win that the iPhone was. Here's what I think happens to Apple. Revenue stays flat or grows very slowly, maybe 2 to 3% per year. Profit margins gradually compress as they face more competition and more regulatory pressure. Services growth slows to low single digits. And the stock re-rates from a growth stock valuation to a mature company valuation. That means going from 33 times earnings to 12 to 15 times earnings. The stock falls from 3.5 trillion to 1.5 trillion, a 60% decline. And I think this happens over the next 2 to 3 years as investors gradually realize that Apple's growth story is over and that they're just a mature cash cow company now. Now let me step back and talk about the common patterns across all 4 of these companies. Because understanding these patterns is crucial to understanding why the entire big tech sector is overvalued. The first pattern is that all 4 companies are priced for perfection. NVIDIA needs AI spending to continue at unsustainable levels indefinitely. Tesla needs to dominate electric vehicles, autonomous driving, energy storage, and robotics all at the same time. Microsoft needs AI to be a massive new revenue stream that offsets slowing growth in their core businesses. Apple needs to reignite growth despite having saturated markets for all their major products. These are all very optimistic scenarios, and the stock prices require all of them to come true. But what are the odds that everything goes perfectly for all 4 companies? Close to zero. Something is going to go wrong. Growth is going to disappoint. Competition is going to intensify. Margins are going to compress. And when reality falls short of expectations, these stocks are going to crash. The second pattern is that all 4 companies are facing increasing competition. NVIDIA faces competition from AMD and custom chips. Tesla faces competition from every automaker in the world. Microsoft faces competition from Google, Amazon, and every other tech company building AI. Apple faces competition from Samsung, Chinese smartphone makers, and regulatory pressure to open up their ecosystem. When you have a monopoly or dominant position, you can charge premium prices and earn fat margins. But when competition intensifies, pricing power erodes and margins compress. That's what's going to happen to all four of these companies over the next few years. The third pattern is that all four companies are dependent on continued massive capital spending. NVIDIA needs companies to keep spending tens of billions on AI infrastructure. Tesla needs to keep spending billions on factories and R&D. Microsoft needs to keep spending billions on data centers and AI research. Apple needs to keep spending billions on R&D trying to create the next revolutionary product. But at some point, this capital spending is going to slow down or stop generating returns. Companies can't just spend billions indefinitely without seeing returns. Shareholders will demand better capital allocation. And when the capital spending slows, the growth narratives fall apart. The fourth pattern is that all four companies have stock prices that have run way ahead of their fundamentals. NVIDIA's stock is up 10x in 2 years. Tesla's stock is up 1,500% from the lows. Microsoft's stock has tripled in 5 years. Apple's stock has gone up 8x in 10 years. These price increases have far exceeded the growth in revenue and earnings. The stocks have re-rated, price to earnings multiples have expanded. Investors are willing to pay more for the same dollar of earnings than they used to. But multiple expansion can't continue forever. Eventually, valuations revert to historical means. And when they do, stock prices fall even if earnings stay the same. This is basic financial mathematics. If a stock trades at 20 times earnings and the multiple compresses to 10 times earnings, the stock falls 50%, even if earnings don't decline at all. All four of these stocks are trading at multiples far above historical averages. When the multiples compress back to normal levels, the stocks are going to fall 50, 60, 70%. The fifth pattern is that all four companies are benefiting from passive index fund inflows. Billions of dollars flow into S&P 500 index funds every month. And those index funds have to buy stocks in proportion to their market cap weighting. The bigger the company, the more money flows in. Apple, Microsoft, NVIDIA, and Tesla are all among the largest companies in the S&P 500, so they get a disproportionate share of all the index fund inflows. This creates artificial buying pressure that pushes the stocks higher regardless of fundamentals. But this can't continue forever. At some point, the flows will reverse. People will start selling index funds, or they'll shift to equal weight indexes that don't overweight the biggest companies. And when the passive inflows slow or reverse, these stocks are going to fall hard because there's no fundamental buying support. Let me tell you what I think the catalyst will be for the sell-off, because these overvalued stocks can stay overvalued for a while. Markets can remain irrational longer than you can stay solvent. As the saying goes, the most likely catalyst is an earnings disappointment. One of these four companies is going to report earnings that fall short of expectations. Maybe NVIDIA's AI chip sales slow down. Maybe Tesla's vehicle deliveries decline. Maybe Microsoft's AI revenue disappoints. Maybe Apple's iPhone sales fall more than expected. When that happens, the stock will crater, and that will spook investors in the other big tech stocks. They'll start questioning the narratives. They'll start looking at the valuations more critically. They'll start selling, and once the selling starts, it feeds on itself. Momentum traders who drove the stocks higher will reverse and drive them lower. Passive index funds will see outflows. Retail investors will panic, and the stocks will fall 20, 30, 40% very quickly. Another potential catalyst is a recession. If the economy tips into recession, corporate spending on technology will decline. AI infrastructure buildouts will slow. Car sales will fall. Software subscriptions will get canceled. All four of these companies will see their revenues and earnings decline. And stocks that are already overvalued will get crushed in a recession. A third potential catalyst is regulatory action. If the government breaks up big tech companies, forces them to open up their ecosystems, or bans certain practices, it will hurt their profitability. The market will re-rate the stocks lower. We're already seeing the beginning of this with the Department of Justice cases against Apple and Google. Let me also talk about the psychological factors at play, because these are important. Right now, investing in big tech feels safe. These are the biggest, most successful companies in the world. They've made people a lot of money over the past decade. Everyone owns them. Your financial advisor owns them. Your index funds own them. It feels like you can't go wrong. But this is exactly the psychological setup that precedes every market crash. Tulip bulbs felt safe in 1637 until they weren't. South Sea Company stock felt safe in 1720 until it wasn't. Railroad stocks felt safe in the 1870s until they weren't. Dot-com stocks felt safe in 1999 until they weren't. Housing felt safe in 2007 until it wasn't. The biggest losses always come from the investments that feel safest. Because that's when everyone is in. That's when there are no skeptics left. That's when the last buyers have bought. And once everyone who's going to buy has bought, the only direction is down. I remember in 2007, everyone thought housing was safe. People had been making money in real estate for years. Home prices had never declined nationwide. Mortgages were backed by real assets. The ratings agencies said mortgage securities were AAA. It felt completely safe. And then it crashed. Housing prices fell 30 to 40% nationwide. Mortgage securities became worthless. The banks failed. Trillions of dollars in wealth evaporated. The people who felt safest, who were most invested, lost the most. I'm telling you, the same thing is going to happen with big tech. It feels safe now. Everyone is invested. Everyone assumes these companies will keep going up. But the valuations are unsustainable. The growth stories are exaggerated. The risks are underestimated. And when the crash comes, it's going to be brutal. So here's what you need to do. If you own Nvidia, sell it now. I don't care that it's up 1,000%. I don't care that everyone loves it. I don't care that Wall Street analysts have price targets of 200 or 250. The stock is going to 50 or lower. Get out while you still have gains to take. If you own Tesla, sell it now. I don't care about the cult following or Elon Musk's promises. The company is worth $150 billion, not $1.3 trillion. The stock is going to fall 90%. Get out before you lose everything. If you own Microsoft, sell it now. It's a good company, but it's not worth $3.2 trillion. It's worth maybe $1.5 to $2 trillion. The stock is going to fall 40 to 50%. Take your profits and move on. If you own Apple, sell it now. The growth is over. It should trade like a mature company at 12 to 15 times earnings, not 33 times earnings. The stock is going to fall 60%. Get out before it happens. I know this is hard advice to follow. These stocks have been great investments for years. It feels wrong to sell them. You'll worry about missing out on more gains. You'll worry about being wrong. But let me tell you from experience, being early is the same as being right. You just have to be patient. I shorted the housing market in 2005 and 2006. I was way early. I had to wait 2 years for the crash to happen. People mocked me during those 2 years. They said I was wrong. They said housing would never crash. But I was patient. I held my positions. And when the crash came in 2008, I made billions while everyone else lost everything. I'm telling you, the same thing is going to happen with big tech. I might be early. The crash might not happen for another 6 months, or 12 months, or 18 months. But it's coming. The mathematics guarantee it. You can't have companies trading at 30, 50, 80 times earnings with slowing growth indefinitely. Eventually, reality catches up. Eventually, valuations revert to the mean. Eventually, the stocks crash. Get out now while you still can. Take your profits. Move your money to safer investments. Cash is fine. Bonds are fine. Value stocks trading at reasonable multiples are fine. Just get out of these 4 overvalued tech giants before they take you down with them. Because when they crash, it's going to be fast and brutal. You won't have time to get out. The stocks will gap down 20% overnight, then another 20% the next day, then another 20% the day after that. By the time you realize what's happening, you'll have lost 60 or 70% of your money. Don't let that happen. Don't be the person holding the bag when the music stops. Get out now. This is your warning.